Okay, for the current period, the computation of the finance cost has not been a challenge. Why? Because the examiner had given us the receivables figure at the year end, and we simply multiplied that with the overdraft interest cost or percentage or 14%. Now, let's compute the finance cost. All right, the finance cost for the proposed policy now. Finance cost. All right. Now, here we can't simply take the 8 million, all right, and slot in it in the figures. All right. We need to adjust it to some extent. So we need some working, all right, to determine the receivables figure we are going to use. All right. And it's not an issue again of simply multiply 8 million by 50%. You would get a wrong figure there. All right. So you need to do some working. Workings. We know that the current period, okay, the existing receivables were taking 48.67 days. Remember, we computed this figure. Don't be confused. We computed this figure. Okay. We computed that figure. All right. So 48.67 days. All right. And in a year, we have got 365 days. We then have to multiply that by 60 million, which is the total sales. The total sales were 60 million. All right. However, of these, only 50%, I mean, 50% are taking, 50% are not taking. All right. So let's talk of those guys who are not taking any discount. So they were 50%. Okay. So in this case, we will arrive at an amount of 4 million. Please use your calculators to confirm this figure. After that, you then have to determine the receivables linked to discount. Okay, receivables linked to discount. Okay, receivables on discount. We are told by the examiner that these guys, if they take the discount, they're going to pay in 10 days, over 365 days in a year, multiplied by 60 million, multiplied by 50%. There will be half of the receivable, 50%. So in that case, we are going to get some figure there. Please use your calculator. Obviously, as the numerator is now lower from 48.67 to 10, then it also means that the receivable figure we are going to get here is actually lower than 4 million above. And this should come to 0.82 million. So the revised receivables would be 4 million plus 0.82 million. This comes to 4.82 million. Okay, so that's the computation for our working. So we want that 4.82 million to be part of our finance cost computation. So we take that 4.82 million multiply by 14%. and we should get 0.67 million as our new finance cost. But these costs do not stop there. There's also the discount cost, because if we give discount, there is a cost attached to it. All right, that 2% is a cost to the business. So in that case, we are going to say discount cost. The discount cost, we are giving 2%. Okay, 2% on what? On sales of 60 million, not 2% on receivables. No, it's 2% on sales, right? Sales to 60 million, but not the full 60 million, because only 50% are taking discount. So we punch those figures into our calculators, and we must get 0.6 million. We add up these figures to get the total cost to the policy, of the policy. So this comes to 1.27 million. So you need to compare now. Is it favorable, given that in the current policy, the total cost is only 1.1 million, 1.12 million? Shall we introduce the discount or not? Obviously, we should not, because it is costly to the company in the longer term, in the short to medium or even longer term. So that's how you arrive at solutions relating to these figures. All right, so now I think we are left only with invoice discounting and factoring. If we do give you a video on that, you are home and dry. You can excel in this area of working capital management. All right, so let's move on to the next issue. Well, invoice discounting and factoring. What is the difference between the two? Okay, invoice discounting is the selling of an invoice to a third party, usually a bank, for a lower discounted amount. This way, the supplier gets cash immediately, and it is the bank who has to wait for payment, hence the lower or discounted amount. So here we are simply saying that, for example, you might be having an invoice of $60 million, all right, from a customer. Then, because you are facing cash flow challenges, you might say that you might negotiate with your banker or a bank that offers such services to say, guys, can you just give me 53 million? 53 million. Maybe you have found an opportunity that needs to be invested into. Then the bank would say, okay, it's fine. We are giving you 53 million. And when your customers pay, please give us the money. So it's something that is related to your credit rating and so forth. They might be trusting you as a good corporation, as a good entity. So they will chip in and give you the money earlier on. However, there is also a charge, and that charge is the 7 million you have lost. That's invoice discounting for you. Now, let's talk of factoring. Factoring or debt factoring is paying another company to administer all or part of the receivables ledger. Depending on the fee paid to the factor, different facilities may be bought. The basic level of factoring involves paying the factor to handle all the administration, that is maintaining the sales ledger and collecting the debts. For a higher fee, the factor will advance money to the company before the debts have been collected. For example, the factor may advance 80% of the value of sales immediately on invoicing. So they might advance you 8% of the sales. So bear in mind here, we are not only talking of one invoice, we are talking of the whole sales ledger. All right, which means there will be a lot of customers will be involved. However, instead of using your own credit control department or maybe the receivables accountants within your organization, you are now going to use some other company to do that work for you. So there is also a fee, of course. There is actually a fee that is very, very significant. For a higher fee still, the factor may accept responsibility for any bad debts. In that case, the company is effectively insuring against bad debts. All right, where the factor is also bearing the risk of bad debts. Some of the customers, which are also included in that sales ledger, might might fail to pay. And in that case, if the factor is bearing the risk, we call that arrangement a non-recourse factoring. A non-recourse factoring. Normal factoring, where the company keeps the responsibility for any bad debt, is known as with recourse. Okay, these have got some financial reporting implications. All right, they have got some financial reporting implications. All right, where there is no recourse, immediately we recognize a sale. Okay, because there's no more any responsibility. But if there is a recourse, then it means that we can actually, we can't immediately recognize a sale because there is a danger that that sale is going to be cancelled and so forth. All right, so that's the idea in this case. All right, now let's talk of a situation where we'll be doing an exam standard question linked to factoring, and if we do that, we then rest our case. Okay, ladies and gentlemen, so let me just look for a question we can do together and then seal the deal.